Hey everyone, unfortunately Fisker stock is down 81% in the last 3 months alone, and the company is struggling to get itself off the ground in increasing production and making deliveries. So in this video, I'm going to answer if this dip in Fisker's stock price is a buying opportunity or if you should still avoid Fisker stock. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned that Fisker's stock price is down 81% in the last 3 months. And this is when the company recently started production and started delivering vehicles. Up until this point, Fisker was not making any deliveries or any sales. So as it started making these sales and making these deliveries, a time that was supposed to be positive for the company, it's turned downward. It's turned sour, mostly because the company is missing a lot of the estimates it initially gave investors. It keeps downgrading its forecasts and missing those forecasts, and then reporting trouble and uh, discombobulation with everything in the delivery logistics networks. And so all of this has led to the company's stock price falling. Now, I will note that about 3 weeks ago, I made a video answering if I thought Fisker stock was a buy for 2024. And in that video, I said no, Fisker stock was not a buy, despite the fact that it was already down 80% in 2023. It still was not a buy in 2024 because it was having so much difficulty ramping up production and turning a concept into a business. Up until this point, it had just been a concept, this nice electric vehicle that's going to drive demand that people really are interested in, and that's going to create this excellent business. That's not really what's happening, and that's what's troubling Fisker stock right now. Is going from that concept to a business is where the company is having difficulty. As a result of these difficulties that the company is having, on January 4th, Fisker announced a new dealer partnership model in a strategic transformation for the company. Previously, Fisker was going to try to do what Tesla was doing in going direct to consumers, selling its products directly to consumers, avoiding dealerships, selling it on their website. And now it's decided that it's going to go with the dealership model because it was struggling to deliver sales with the direct to consumer model, and it was struggling to deliver the cars. Surprisingly, all this time Fisker was getting ready to ramp up production and make sales. It had these customer orders already, but they didn't get the logistics ironed out. They didn't figure out how they were going to take the cars from the production facility and deliver it to customers. They didn't figure that part out. And so now that they started ramping up production and cars are being produced in the thousands of units, customers are buying. Some, not all customers are buying, but they're not, you know, it's too expensive for them to deliver it. And so now they're changing and going the dealership model, which it's two things I'll highlight with the dealership model. Number one, it's going to help solve that problem of deliveries to some point, right? 100 dealership locations is not a big amount of locations. There's still going to be customers that are hours and hours drive away from a dealership. So how is that going to happen? How is that going to work? And then on top of that, the second thing is that this is going to cost Fisker more money. They're going to have to give these dealerships something in exchange for selling Fisker cars in their dealerships. They're going to have to offer them either commission or a fixed rate, something, and that's going to hurt Fisker's bottom line, which is already significantly negative. Let me show you that. This is the company's latest quarterly financial statement, and in the quarter that ended September 30th, Fisker generated 71.8 million in revenue and a negative gross margin of 12 million. On the bottom line, they lost 91 million. And so if you add more costs onto this already negative base, that's only going to make things worse. Even if it increases sales, you're going to increase sales, but you're still going to lose more money, just like they did here. Look at what happened in the quarter that ended June 30th. The company barely had any revenue and they lost 88 million in operations. But when they started to generate revenue, that loss worsened. They went from 88 million to 99 million because to generate those sales, they had to nearly double their selling, general, and administrative expenses. And then their cost of goods sold increased by 83 million when their sales only increased by 71 million. So the company's not at scale anywhere near that to start generating profitability, which is surprising because they're running an asset-light business model. They're outsourcing production and now they're outsourcing sales to dealerships. So that's going to take their margins on a negative direction. Also, I talked about the worsening of their forecasts or giving forecasts and then producing worse, right? So here they said they're gonna, based on their capacity, they were gonna deliver between or produce between 13,000 and 17,000 vehicles in 2023. Turns out they only produced 10,000 vehicles in 2023. So their forecast was for 15,000 vehicles at the midpoint, and they ended up producing only 10,000. So 33% lower than what they were forecasting. On top of that, they only delivered 4,700 of those, highlighting that difficulty they had between production and getting those cars in customer hands. And so you can understand all of these factors are weighing in on the valuation as investors are becoming less confident that this management team can turn this into an effective business. They have yet to prove that, and that's really where investors have been skittish with Fisker. Is yeah, it's a nice looking car. It's an EV. The world is moving towards EVs and all of that tailwind they have going for it, but to turn it into a business, the company hasn't proven that yet. So after the sell-off, Fisker is selling at a forward price to sales ratio of 0.106. This is the cheapest this stock has sold for according to this metric all year long. It used to sell for a forward price to sales of over 1 to start the year. Now it's at a fraction of that valuation. But still, if I was to answer if Fisker stock is a buy on this dip, I would still say no. I would still say no because they haven't proven that they can turn this into a business. They've made so many mistakes, so many downgrades, so many forecasts that have been missed, so many cost overruns that I just need to see them execute effectively for 1 or 2 quarters at least. I don't mind paying a higher price, but after they prove that they can turn this into a business. So I know if after they prove that, the stock price will go up and I might have to recommend it at a higher price, but that would still be better than buying this at this value when it's so much more speculative at this point because they haven't proven hardly anything at this point. So I'd rather wait for them to demonstrate some more competency in running the business, and then I can feel more confident recommending Fisker stock, even if it is at a higher price. I'd rather pay a higher price, but with significantly lower risk, than pay a lower price with significantly higher risk. And so that's where I'm coming from when I'm not recommending Fisker stock as a buy right now. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.